How to start investing in Canada. First of all, it's great that you ask yourself this question because no matter your income level, it's a great idea to start investing, even just small sums, as soon as possible so that you can benefit from the power of compounding. Most people delay investing because they either do not understand anything about investing or they think it's just too complicated. But let me tell you, actually it's not. It can be pretty simple. But where do you start if you're a beginner? In this video today, I'm going to talk about 6 steps to follow if you want to start investing as a beginner in Canada. Step number 1 is to educate yourself about the basics. Before you rush out and go and buy your first share, it's first important to get a basic understanding of the different types of investment products, how they work, and also what they do for you. I'll not go into too much detail today, but just as an overview, here are the different types of investment products: cash and cash equivalents, fixed income securities, equities, investment funds, and alternative investments. And you can pretty much learn anything that you need online. And within each of these investment categories are different types of investment products. For example, a GIC or a Guaranteed Investment Certificate falls under the category of cash and cash equivalents. And just to illustrate how different investment products can work, let's just briefly compare GICs with shares. So what makes the GIC or Guaranteed Investment Certificate unique is that the principal is guaranteed. So if you, for example, invest $5,000 in a GIC, then that $5,000 is guaranteed. Even if the financial institution goes bankrupt, you won't lose the money because it's protected by the CDIC or the Canadian Deposit Insurance Corporation, up to a certain maximum. Compare that to shares. If you buy a share is not guaranteed at all in any way. The value of the share could go up, but it could also go to zero and you lose all your money. A GIC usually pays you fixed interest. There are also GICs that are linked to the market. But in general, a GIC guarantees you the payment of a fixed interest. So in advance, you will know exactly how much money you will get after a year or 2 years or 5 years, depending on how long the maturity of the GIC is. The income scheme is totally different with a share. You can earn money from a share when the value goes up and you sell the share. The difference of the price at which you sold it and at which you buy it is your profit. On top of that income from growth, some shares also pay out dividends. You can see how a GIC has less risk than a share. And for each of the other investment products, you will find that there are different kinds of returns as well as a risk level. You also need to understand that when you invest, there may be certain tax implications depending on whether the share you're buying is a local or a foreign share. If you, for example, buy a US stock and you earn dividends, then taxes may apply to that. So that's something to be aware of. One thing that many people ask about investing, especially when they're just starting off, is about the risk. And yes, it's important to know that every investment product comes with some kind of risk. For some investments, such as shares, the risk is that you could lose all of your money. And that is why it's very important that you, in any case, do not invest all of your money into one single share. Don't put your eggs in one basket. It's important to understand a bit about the concept of an investment portfolio. An investment portfolio is basically a pie of your different investments, and you do not want that entire pie to consist of just one share or just one mutual fund. A better idea is to diversify your holdings, meaning that if, for example, your assets total $10,000, you want those $10,000 to be divided up into different slices of the pie. For example, you have some shares, you have some mutual funds, you have some bonds, etc. What kind of shares exactly you invest into and in what proportion, that of course is a different question. Another really basic thing to understand is the relationship between risk and return. People who just start out investing, who have never invested before, get very easily enticed by very high returns. If they say that some kind of, let's say, alternative investment product pays 2% per month, they think that that's a no-brainer, just go for it. But it's important to know that in general, an increase in return or income goes hand in hand with a higher risk as well, which is also known as the risk premium. So a higher return usually signals a higher risk. So whenever you see an investment product paying a very, very high return, higher than anything else, then that's the time to be really alert and ask yourself, what is the real risk risk here and do your research. On the other hand, a lower return is usually a sign that the risk is relatively lower. And also guys, before you start investing in anything at all, I need to stress the importance of always doing your own research. No matter what someone tells you, including me, or advertise, always make sure that you do your own research before signing up to anything. Unfortunately, in this world, yes, there are scammers trying to take advantage of you, and also there is such a thing as taking on too much risk, and you do not want to expose yourself to more risk than you can handle. That being said, a very important disclaimer guys, I'm not a financial advisor. I have a background in banking, although I haven't worked in banking for the past 10 years plus. I'm not a financial advisor, consultant, or planner, so before you make any financial decision, always make sure to do your own due diligence. Now let's go on to step number 2. Before you start investing, consider maximizing your returns with registered savings plans or tax-sheltered accounts. In Canada, these are registered accounts like the TFSA, the tax-free savings account, or the RRSP, the registered retirement savings account, and there's also an education account. To give you a very brief and collapsed summary, the RRSP and the TFSA each are like pots into which you can invest money and to which certain rules apply. Let's take for example, the RRSP, the Registered Retirement Savings Account. Any amount that you contribute to your RRSP up to a certain limit is not taxed. So if you earn $80,000 and you put $5,000 of your earnings into your RSP, the $5,000 is not subject to income tax. The TFSA, or the tax-free savings account, also has tax benefits. The difference is that the money that you invest into the TFSA has already been taxed. Let's say that your gross income is $80,000, and for simplicity's sake, let's say your take-home pay, your net income is $60,000. Of that $60,000, you take $5,000 and put that in your TFSA. That means that that $5,000 had already been taxed. But the benefit is that that $5,000 in your TFSA can grow tax-free. So when you buy shares, for example, using that $5,000, and over 5 years, that grows to become, let's say, $10,000, and you sell your shares, that $5,000 profit will not be taxed because the money had already been taxed before you put it in your TFSA. So this is a very simplified explanation. There's much more to this. So if you want to learn more about the RSP, TFSA, also the FHSA, and so on, then you can click on the playlist up here where I have more videos for you. So if you're about to start investing in Canada, do not just go and buy shares through your bank or sign up with an investment platform and buy an investment product. Make sure that before you do it, you consider carefully whether putting your money into either of these pots, TFSA or RSP, is more beneficial to you from a tax perspective. So once you put that money into the RSP or TFSA, then within those registered accounts, you can make your respective investment decisions. Now let's go on to step number 3. You need to have a basic strategy, and it's nothing complicated. You can write it on a piece of paper, on a notepad, or just make a simple Excel table, and you can always change it later. The point is just to have a simple guideline for yourself as to how you're planning to invest your funds, so that you're not all over the place and making spontaneous decisions that you may regret. And here are some of the sub-steps that I would suggest. First of all, look at your income and decide of that income, how much do you want to save and invest versus how much do you want to spend. And it seems like a small decision, but it is really life-changing. Depending on whether you spend 80% or 90% of your income or 50% of your income, you'll end up in a totally different place financially 10 years from now. Also consider of your income how much you want to put aside each month to pay debt, if you have any debt, which I hope you do not have. Another really important thing before you start investing is to think about how much money you want to put aside in your emergency fund. If right now you have zero money in your emergency fund, then I would suggest to start with that first. Of course, it would be ideal if you had a minimum of 6 months of income as your emergency fund. But in reality, it may take you some time to accumulate that. So I'd say that rather than having nothing, zero, it is still better to have, let's say, a 2-month or 3-month emergency fund. So put that money aside as well. Now, after subtracting all these amounts, how much you need to spend every month, how much goes to debt repayment, and how much you put aside for your emergency fund, then you are left with the amount of how much you can save and invest. And let's just say, for example, that is $500 per month or $6,000 per year. Try and come up with a very basic strategy, a plan as to how you want to invest this $6,000 per year. If you arrived at the conclusion that yes, you want to put some money into your RSP and also put some money into your TFSA, now the next step that you may want to think about is how you want to diversify your portfolio. So of this $6,000, how much will you put into shares, how much into bonds, how much into mutual funds, ETFs, GICs? But to avoid becoming overwhelmed, do not overcomplicate it. Just start off with something very simple. Simply start with 2 or 3 different investment products and split your target investment amount among these. While progressing on your investment journey, you can always change your strategy. I really don't want to make any recommendations as to what to invest in, but I really need to share with you guys about ETFs or exchange traded funds. When I started investing, I invested the majority of my money into ETFs because it's simply a beginner-friendly way to invest, I would say. So what is an ETF? To make it very simple, an ETF is like a basket of different shares. It could have 100, 200, 300 shares within it. For example, there is an ETF, an exchange-traded fund that mirrors the S&P 500. The S&P 500 or the Standard & Poor's 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. So in simple terms, if you buy into the S&P 500, it's as if though you are investing into each of these 500 companies, although that tiny piece is like 0.0000 and so on something percent. And in Canada, yes, you can find an ETF that mirrors the exact movement of the S&P 500. So why are ETFs interesting for beginners? It's a great option because an ETF itself is already diversified. It already contains various shares, usually the top shares in some category. It could be largest companies, top paying dividends, and so on. So a lot of the work is kind of already done for you, and you don't have to go out and research each of the stocks by yourself and make a decision as to which stock you want to invest in. And that's especially useful for beginners because as a beginner, usually you do not have as much knowledge about the market. Let's go on to step number 4, which is start soon but slow. What does that mean? By starting slow, I mean start with small amounts. As a beginner, don't go in there and immediately invest all the money that you have. If I were at the beginning of my investment journey, I would start off with very small sums as little as just $50 or $100 per month. The advantage of doing that is that as you learn more about investing, you can gradually increase the amount that you invest. And with that, you can avoid making investment mistakes. But there's also another advantage of starting with small sums of money. I know there are many people who just don't start investing because they think that they need to wait until they have a 6-figure income or until they have $1,000 spare money each month to begin investing. But that's not the case at all. Nowadays, because there are so many online platforms where you can invest on your own, you can start with sums as little as $50 or $100. So there's actually nothing really keeping you from starting to invest. I mean, just think about how much eating out nowadays costs. A meal for 2 in a mid-level restaurant will cost you $60 to $70 if not more, including drinks, tips, and tax. So instead of doing that too frequently, you may as well take that money and start investing. While you want to start slow, you also want to make sure to start soon. Do not delay the start of your investment journey for too long. We made the mistake of waiting a bit too long. When we just moved to Canada, in the first 2 to 3 years, we were so busy getting settled, studying, looking for a job, and applying for our PR, and we totally forgot about investing. We actually had some money lying around at that time, but we simply didn't start, so we missed out on all that growth. So even though you only have a very small amount of money to invest in each month, start as soon as possible so you can benefit from the compounding effect. Not only that, but by starting earlier, you can also accelerate your learning. Now let's move on to step number 5, which is to pick a platform on which to invest. And there are many options for this. You can just go to your bank and trade online, or you can sign up to an online trading platform, of which there are so many nowadays, including Questrade, Wealthsimple, and many more. And the traditional banks offer online platforms such as Scotia iTrade, TD Direct Investing, and so on. Before you sign up with any platform, make sure that you check what the fees are. because the fees can potentially set you back quite a lot. And this is what usually happens when you sign up for a trading platform. So personally, my husband and I, we both use Wealthsimple to invest, and I've been pretty happy with it. I can't say that it's the best. I would love to say it's the best, but I can't because I simply haven't tried any other investment platforms. But so far, I can't complain about Wealthsimple. I think that it's very, very easy to use. It is intuitive, and also there's no commission when trading. And yes, on platforms such as Wealthsimple, you can open the registered savings plans that I mentioned before, such as the RSP and the TFSA, and you can even trade crypto, although I wouldn't go there immediately as a beginner. So just in case you also want to try out Wealthsimple, first of all, make sure that you do your own research and see if it's right for you. And if you think that it is, then you can go and click on my affiliate link down below. If you click on that, it will take you to Wealthsimple, and when you sign up, I may be eligible for a small commission. Now, after you signed up for a trading platform, you're all set. You just need to transfer your money and you can start investing. But not so fast, because step number 6 is to research each and every product before you purchase it. Don't just go out and follow the crowd and buy what seems to be trending and what your colleagues and neighbors buy, because it's your money, guys. You alone are bearing the risk. So you want to make sure that you are comfortable with what you are buying and only purchase investment products that you understand. I mean, of course, our understanding may be somewhat limited, but at least you need to have a good idea of the risks involved. For example, if you buy an ETF, what was the past performance of this ETF? And also, what are the management fees? Because the management fees will eventually reduce your return. So guys, this was a very basic guide for how to start investing in Canada. Please do let me know in the comments what you think of this video. Is there anything that I forgot to mention? Please feel free to add that in the comments. This is of course not all there is to investing, but I think that you start with these 6 steps, then you'll be off to a very rewarding and also safe investment journey. I hope you enjoyed this video, guys. As always, thank you so much for watching, and I'll see you pretty soon in the next video. Bye!